What's up everybody, Nate here. And earlier this year, we witnessed some of the largest banking collapses in global history, with Silicon Valley Bank, Signature Bank, and First Republic Bank going under. Now, because of some quick work from the Treasury Department, the Federal Reserve, and some bigger banks essentially bailing out these smaller banks, we were able to avoid a full-out banking collapse and a crisis here in the United States. And over the last few months, we haven't really heard much about the banking collapse since. It seems like the crisis is pretty much over. Well, it looks like we are starting to see some big fallout from those collapses. European banks are bracing for one of the largest defaulting sprees in global history. Meanwhile, here in the United States, Congress is getting ready to pass some of the biggest regulations that the banking industry has ever seen. This all has some huge implications for banks, investors, and consumers. So what exactly is going on? Well, if we turn to Europe, banks are getting ready for a lot of their loans to essentially start to go into default. This is because of two major reasons. The first has a lot to do with interest rates. Now, this just isn't a European problem, this is a global problem because central banks across the world have been steadily raising their interest rates for the better half of the last year. And the reason for that is in response to inflation. Now, I don't have to tell you that inflation has been extremely high, not just here in the US, but across the planet, as many other countries have printed a lot of money over the last couple of years, and they had really low interest rates in order to stimulate the economy in response to the pandemic. Well, so what exactly has that done? Well, every single time those interest rates go up just a little bit more, that makes it a little bit more difficult for consumers and investors and banks and pretty much everybody to borrow money. And now pretty much everybody is getting hit really hard because of higher interest rates. It is a whole lot harder for institutions and businesses to pay off the loans that they've taken out because those interest rates are going up as central banks have raised their interest rates. Basically, the trickle-down effect works like this, at least here in the United States. So the Central Bank of the United States, the Federal Reserve, tells the Treasury Department how much money needs to be printed, but it also affects how easy or how difficult it is to get that money. So when the Treasury Department finally goes out and prints a bunch of money, well, that money is now going to trickle down to banks and other financial institutions. Banks are the ones that are going to be giving out these loans, like a mortgage loan, an auto loan, and they're going to help investors to borrow money so that way they can invest a lot more cash. But the issue is, if banks are having a hard time getting their money, then they're going to make it a little bit more difficult for you to use theirs, hence the higher interest rates, and hence everything being much more difficult to buy in 2023. So now with those interest rates going up, it's harder for businesses to spend money, it's harder for banks to spend money, and it's harder for consumers to spend money too. Specifically, businesses are having a really tough time because a lot of the loans they take out are adjustable, meaning that if central bank interest rates go up, that means it's costlier to now pay for their debt. Obviously, the inverse is true too, but higher interest rates in 2023 have made it a lot more difficult for European businesses in general to pay back their debt, and they simply are not able to right now. That's because businesses are getting hit with a bunch of other things too. Higher inflation is bringing on a lot more costs. Meanwhile, consumers are not spending as much money because they are also getting hit with inflation, and wages aren't going up fast enough for people to buy the same amount of things. So businesses have higher costs due to inflation, they have higher costs due to the debt that they've already taken on, and they're not getting as much money from consumers right now, which means the only other way that they can get money is through investor liquidity, which they're not able to get as much right now because it's a lot riskier for investors to borrow money when interest rates are high. So basically what we're starting to see all across Europe is all of these different businesses default on their loans because they don't have the money to pay for them. And one of the biggest areas of concern here, and one of the biggest areas that is at risk, is commercial real estate. Interest in commercial real estate from businesses has pretty much been getting smaller and smaller every single month because of things like the pandemic and this push for work from home. That remote work has made it a lot more difficult for businesses to justify having these multi-million-dollar facilities. So a lot of them are simply just leaving because their employees want to stay at home. Not to mention, it's saving businesses a lot of money, but there are bigger ramifications here for consumers and the areas that these businesses are leaving. With businesses going towards remote work and they're leaving a lot of their inventory behind with these commercial office buildings, well, that means that a lot of employees are no longer going to big cities. A lot of employees are not sort of stimulating those local economies anymore, which means a lot of those businesses that used to get business from those employees working in those offices are now starting to lose a lot of cash. The same thing is happening here in the United States as well, as we're starting to see the same type of defaults and the same type of ideologies from businesses who are leaving office buildings. They are not re-signing their their leases, and that's a big problem for those local economies. The reason this is bad for banks is because they have a ton of cash on the line here, and if they start to see a lot of defaults and people unable to pay their debts anymore, well, that means that they're not going to have the same amount of liquidity to go out and invest in other businesses or give out as many loans, and they're not going to have as much cash available to do pretty much anything. That creates a cause for concern and something called a credit crunch, something that we are currently undergoing here in the United States. A credit crunch means that it's a lot harder for A, people to borrow money, but B, borrow money from banks. Banks are now going to adjust their lending standards and make it harder for people to get mortgages and auto loans and borrow money in general because they don't want people to default on loans. They're going to be very selective, meaning that access to things like mortgages and cars is going to be a lot harder for millions of people. Raising their lending standards means that people are going to have higher incomes and higher credit scores in order to secure loans, which again is going to be tough for the average American in this economy because the average American is leveraging credit card debt more than ever because of inflation and the cost of things going up. Meanwhile, their wages are not going up nearly as quickly. So all of that financial strain is just going to make it harder for everybody to get by. Of course, some people will still be able to, but what this situation sort of creates is a greater divide between the haves and the have-nots in the United States. So that's the first issue, and it's not something that's just affecting Europe, it's also affecting the United States. But here at home, we have something else going on, and that is regulations from Congress. Now, one of the reasons that Silicon Valley Bank failed in the first place is because it was taking on huge losses from a lot of its investments, and it didn't have enough money in the bank to protect all of its depositors. So in a nutshell, when people realized that Silicon Valley Bank was losing a ton of money, they ran to the bank to try to get all of their money out. But Silicon Valley Bank basically showed them the door. They did not have the liquidity to cover all of their depositors' funds, but that might be changing in the future. Congress is looking to potentially pass a bill that would essentially make it a lot harder for banks to not have enough money in reserves. And you're probably thinking, how is that even possible? Like, how exactly did Silicon Valley Bank, with all of these billions of dollars in depositors' funds, not have the money there? I mean, when you put your money in the bank, shouldn't it stay there? Well, that's not exactly how banks work. Banking in the United States functions off of a system called fractional reserve lending. What that means is that when you take $100 to the bank, well, the bank is only legally required to keep, say, around $10, and then they take that $90 that's remaining and they go out and invest it, and that's how banks make a profit. Otherwise, banks would just have hundreds of billions of dollars sitting in vaults, which would not be very safe, and it wouldn't make them any money. Also, now Congress wants to increase the amount that banks have to keep in reserves. That number is still up in the air, but the bottom line here is that it's going to affect banks that have $100 billion or more in funds. So we're talking about the major banks around the world like JP Morgan Chase, Wells Fargo, and Bank of America. That will make it so if there is a run on the bank, well, it might not be as catastrophic because banks have to have a certain amount in reserves in order to be considered a bank. Now, this has its pros and cons because on one hand, this definitely protects consumers and it definitely protects a lot of individual businesses, right? Because now if you go to the bank, you can be pretty much sure that the bank is going to have your money. Even if the bank is failing, it's only able to invest a certain portion of its depositors' funds. So that means there is a better chance that you're not going to see a global meltdown. However, on the flip side, this means that a bank isn't going to have as much money to invest. So banking revenues and income are going to start to shrink, which means banks are not going to invest as much money. So the startup scene is going to be massively hit here, which means businesses are not going to have as much growth in the United States. And it also means that there probably is going to be a bigger crunch on credit. Banks have to be very careful who they're going to lend money to, which means they don't want to take a loss on their cash because they only have so many funds to work with. The other thing that Congress is working on is banks that are around $100 billion in value or have about $100 billion worth of depositors' funds are now going to have to report losses on pretty much all of their assets. Regional banks didn't really have to do this. There was a loophole that was passed several years ago that made it so they only had to report losses on certain assets. It means investors and depositors could basically get tricked about how much money that bank actually had in its reserves. Now it seems like banks are going to have to be a lot more transparent with investors, which I personally think is a good thing for the industry. It's going to create a lot more competition because now this move is going to reveal which banks are over leveraged and which banks are going to have the most issues. Investors and businesses should choose banks that they believe in and that they believe that their money is secure. I think that this is going to help them do that. And the last thing that Congress is talking about right now is creating a standardized system for lending in the United States. So right now, banks have their own individual individual lending standards. I mean, sure, there is a few standards that are set by the federal government that banks must follow when lending out money and allowing people to borrow their funds. However, banks have a lot of control over their money, and if you want to use a bank's money, you have to follow their rules. That might completely go away for banks that have around $100 billion worth of depositors' funds. There might be a standardized system that allows basically everybody to borrow money. Again, this has a lot of pros and cons because on one hand, it sounds like it's going to make it a lot easier for people to get access to credit. It's going to make it a lot easier for people to go out and get loans and borrow money. And that could definitely be true, but we'll have to see what the lending standards are, because if the standard is set by the federal government, then banks have to follow it. But it might be a standard that is way too difficult for the average American to meet, meaning many people are not going to be able to borrow money because of these standards. But if the bar is way too low, then too many people are going to be able to go out and borrow money all at once, and that's going to lead to, yeah, bank revenues and income going up, but it's also going to lead to massive debt for a lot of Americans. They're going to go out and borrow as much as they can because that's what the vast majority of Americans do. And during a time when we have Americans who are pretty much more in debt than they've ever been, rising inflation, and a potential unemployment crisis on the horizon, you can see how this could be a problem. Now look, none of this has happened yet. Congress has yet to actually enact any of these laws, and the European banking sector is not facing a large default just yet, but these are some things that could potentially be coming in the future. And they are things that you need to keep an eye on because they massively affect your money. It's clear here that one of the biggest overarching themes of our economy right now is that the rich could potentially get richer because of all of these issues, because they know how to handle their money and they have the right financial education in place. Meanwhile, the poor and the less fortunate could get a whole lot poorer and become even worse off because they don't know what to do. But what I'm saying is that there's opportunities out there for those who know how to capitalize on them. And that is exactly what we talk about on this channel 7 days a week. So if you haven't subscribed yet, make sure to hit that sub button below. Let me know what you think about this banking crisis 2.0 in the United States and across the world. Do you think that we're about to see a global economic and banking collapse, or do you think that the banking sector is pretty much just gonna figure itself out like it always has? That is it for me, everybody. Be kind out there, and I'll see you all in the next one.